This hearing of the Subcommittee on Capital Markets, Insurance, and Government-Sponsored Enterprise will come to order. Pursuant to agreement with the ranking member and to allow as much time as possible for members' questions, opening statements today will be limited to 10 minutes on each side. Without objection, all members' opening statements will be made part of the record. We meet today to discuss the issue of systemic risk, the bailout of American International Group, the bankruptcy of Lehman Brothers, and the takeover of Bear Stearns. Each demonstrate that systemic risk is not just confined to the banking sector. We therefore will focus our examinations at this hearing on insurance, securities, and capital market issues. The ongoing turmoil in our financial markets has led us to a crossroads. Because our current regulatory regime has failed, we must now design a robust, effective supervisory system for the future. In doing so, we must move expeditiously in order to help restore confidence in our markets and to get our economy moving again. We must, however, also move carefully and take the time to do it right. We should not rush to judgment on developing a new systemic risk overseer. We must also put aside our partisan differences and aim at the onset to reach a genuine consensus. Perhaps most importantly, we must start at the beginning and ask some basic questions. First, we must define systemic risk. Does a financial services company pose a systemic risk if it is too big to fail, too interconnected to fail, or too leveraged to fail? Could the independent actions of many small players compound to create a systemic risk? Do only financial service providers pose a risk? For example, could the technology used in our financial markets pose a risk to the broader economy? Moreover, are there certain financial products, business activities, or industry segments more likely to cause risk than others? How can we distinguish which is which? Today's witnesses will help us to start answering these complex questions and to begin defining more concretely the amorphous concept of systemic risk. Second, we need to ask ourselves how the government can work to diminish systemic risk. Should we create an umbrella overseer? If so, how should such an entity operate? Alternatively, could existing regulators overtake this objective? If so, how should we address the products and parties that operate in the shadows of our financial system and outside of regulatory oversight? Third, and arguably most important, how can the government prevent an institution from becoming too important to fail going forward? Should we impose a systemic risk test as part of a government review of mergers? Moreover, could the financial innovations of one company or one sector contribute to systemic risk? Today, we will spend much time studying insurance issues. Our panel has examined insurance regulation many times, but this debate is different. This debate is about recognizing that insurance is a part of an integrated financial services system. Insurance companies and their affiliates, in some instances, could pose risk to the broader system. American International Group is a perfect and severe example of this reality. In other instances, insurers could be negatively impacted by ratings downgrades, capital impairments resulting from external events, and the application of accounting standards. We will also learn more about credit default swaps, a product that sometimes operates as an insurance contract and sometimes as a securities product. Credit default swaps have generally fallen through the cracks of our fragmented regulatory system. Therefore, Congressman Backus joined me in asking the Government Accountability Office to study credit default swaps, and an expert will share GAO's findings today. Hedge funds, too, are largely unregulated. After the government-organized rescue of long-term capital management in 1998, the President's Working Group made legislative recommendations for preventing future systemic risk by hedge funds. I subsequently joined with the then Capital Markets Chairman, Richard Baker, in proposing the Hedge Fund Disclosure Act and moving it through a subcommittee markup. Even though our bill did not become law, I welcome Mr. Baker back to Congress today in his role as the leader of the Managed Fund Association. This time, he and I have another chance to ensure that hedge funds are appropriately regulated and our economy better protected from systemic risk. This time, we will hopefully succeed. In closing, the work ahead of us is important and necessary. I look forward to the testimony of our witnesses and to engaging in a productive debate on these issues. I would like to recognize the ranking member for 4 minutes for his opening statement.
Thank you, Mr. Chairman. As always, it's a pleasure working with you on this subcommittee's business, and I look forward to today's hearing and hearing different perspectives on these financial market regulatory systems. For me, as with you, there are several fundamental questions that need to be answered as we embark on examining the potential future for such a systemic regulator. First, as you say, we still don't have a single agreed-upon definition of exactly what is systemic risk, nor do we know exactly what a systemic regulator would be, what roles it would have, who would be under its jurisdiction, etc. Secondly, the committee needs to be careful not to get ahead of itself. We cannot come up with an appropriate solution in this area until we have a better understanding and more consensus on actually what the causes to our current financial situation is. This subcommittee and the full committee have a lot on its plates, and a lot is at stake on what this Congress ultimately decides to do in the area of regulatory reform. I can't stress this point enough. We need to get this right and not move too quickly simply to illustrate that we are, quote, doing something. What we do know is many areas of our financial service sector already are subject to significant regulation, are some of the areas that with most of the problems. Bear Stearns and Lehman Brothers, not to mention the Bernie Madoff situation, they were regulated by the SEC. IndyMac and Washington Mutual were both regulated by the Office of Thrift Supervision. Additionally, OTS has oversight responsibility for the unit of AIG where most of its problems originated. The Federal Reserve itself, which is often mentioned as a potential candidate for a systemic risk regulator, certainly has a regulatory record that really leaves a lot to be desired. Its handling of monetary policy in the years leading up to the current crisis is often mentioned by many experts as enabling the events. Furthermore, the Fed already has the role of safety and soundness and prudential limits regulator for large banks, holding companies, companies such as Citi and Bank of America, which are two of the largest recipients, as I should point out, of federal TARP funds, and whose perceived uneasy state have led to much of the uncertainty in the rest of the market. You think about it, if all these and other regulators were already on the job but didn't do a good job with the powers vested in them, then why should we have faith that a new super regulator of systemic risk will do any better than them? The Fed in particular raises certain concerns for me. It already has significant responsibilities in areas of monetary policy as well as its ongoing bank regulatory role. In addition, as an independent institution, there seems to be a certain lack of political accountability for its actions. I'm not sure it's really wise to consolidate so much additional responsibility in an entity that does not have to answer to the American people. Furthermore, the Fed has no particular expertise regulating entities outside the banking areas, such as insurance and securities, two potential areas that would be asked to oversee if it was to become the regulator. There are other aspects that concern me about certain systemic regulator proposals that have come out. Chief among these is concerns in identifying institutions with systemic significance. If this were to be done, the market would likely view these institutions having de facto guarantee of federal government support during times of financial stress. Does that sound familiar? Not only would this designation likely lead to unfair advantages in the marketplace, such as lower cost of capital, but it would also socialize market failure while leaving profits in the private hands. This is exactly what happened with Freddie and Fannie, and we've seen how that all ended up. So in sum, Mr. Chairman, I've not been convinced that there is a workable systemic regulator solution that would provide the net benefit to our economy going forward. But with that being said, we are just at the beginning and not the end, and I look forward to the testimony here as we go forward, and I thank all the witnesses for joining us here today.
Thank you, Ranking Member Garrett. Next, we'll hear from Mr. Ackerman of New York for 2 minutes.
Thank you, Mr. Chairman. In my view, our examination of systemic risk must include both an in-depth analysis of the role that credit ratings and credit rating agencies played in creating the current economic crisis, as well as consideration of the mark-to-market accounting standard. I've long believed that allowing the SEC to grant the largest credit rating agencies nationally recognized statistical rating organization status is the equivalent of stamping a government seal of approval on the ratings that they issue. Unfortunately, as we know now, the SEC was woefully inattentive to the rating process over the last several years, and many AAA-rated securities, particularly those that were mortgage-backed, did not in fact exhibit the fundamental characteristics of a sound, safe investment. Mr. Castle and I have reintroduced legislation to institute a dual structure for credit ratings issued by NRSROs. Credit rating agencies would still be permitted to assign their own ratings to securities composed of different types of assets that are then consolidated within packages of different types of financial products. However, a new class of ratings would be created under which only homogeneous securities with proven track records could be rated. As the committee moves to consider reforming our country's financial services regulatory structure, I would urge our colleagues to take a look at H.R. 1181. I'm eager to hear our witnesses' perspectives on the effect that mark-to-market has had on the current market conditions, and, if not rescinded, their forecasts for the impact mark-to-market will have on systemic risk in the immediate future. In the current economy, it makes no sense to compel companies to mark their assets to market, since there often is no market. The drastic overnight write-downs that many companies have been forced to take because of mark-to-market has surely exacerbated systemic risk, and I'm interested to hear from our witnesses how we can alleviate this effect while maintaining an effective and transparent standard for evaluating assets. And I thank you, Mr. Chairman. Look forward to hearing from our witnesses, and welcome back our former colleagues, who I think I haven't seen in about 1 year.
1 year? Thank you very much, Mr. Ackerman. And now we'll hear from the gentleman from California, Mr. Royce, for 3 minutes.
Thank you, Mr. Chairman. The fact that many of our financial institutions have become too big to fail or too interconnected to fail has become shockingly apparent. The steps taken by the federal government and the amount of tax dollars allocated because of systemic threats have not been seen in recent history, either here or in the UK or by other central banks around the world or other democracies around the world. The long-term effect of these actions will not be fully understood for some years to come. But we cannot wait until then to act on the regulatory shortcomings that have been exposed so far by our economic downturn. The exact makeup of these reforms will be debated here in the coming months. As the president of the Richmond Federal Reserve has noted, the critical policy question of our time will be where to establish the boundaries around the public sector safety net provided to financial market participants now that those old boundaries are gone. The moral hazard problem created by the implicit government guarantee of Fannie Mae and Freddie Mac is a perfect example of what not to do. This quasi-public model and the apparent market distortions it caused must become a thing of the past. Richard Baker is here with us today. He, along with the Federal Reserve Chairman, the Treasury Secretaries, came before this committee 16 times, I counted, and warned about the over-leveraging at 100 to 1 at Fannie Mae and Freddie Mac, warned about the legislative mandates for those institutions to purchase subprime and Alt-A loans and package them into mortgage-backed securities in order to drive affordable housing. They all warned of the systemic risk of this, and we all witnessed the central role these government-sponsored enterprises played in the run-up to the housing bubble. And now all Americans are feeling the pain of the economic fallout that originated in our housing sector. The invitation for political and bureaucratic manipulation will remain as long as the line between the federal government and private institutions is blurred. Beyond reestablishing clear boundaries around the federal government's safety net, it is critical that regulatory gaps in our current system be filled. Our acting systemic risk regulator, Ben Bernanke, made his feelings known earlier this week in this committee when he expressed his frustration, first over at the Senate side with AIG's ability to exploit a huge gap in the regulatory system. This regulatory gap must be filled by a world-class federal regulator for insurance, a step supported here last week by Ben Bernanke, the chairman of the Federal Reserve. The various state insurance regulators simply do not have the ability to oversee massive global financial firms like AIG. This void has gone unfilled for too long, and the problems that have resulted because of this gap are many. The federal government and now the American taxpayers have a vested interest in the ability of this Congress to establish a world-class regulatory alternative to the fragmented 50-state system overseeing the insurance market. And again, thank you for holding this hearing, Mr. Chairman, and I yield back the balance of my time.
Thank you, Mr. Rice. And now we'll hear from the gentleman from California, Mr. Sherman, for 2 minutes.
Thank you. Systemic risk regulator. Everybody knows that we need one. Nobody knows what it is. We ought to have many entities that are not regulated, particularly if they're not, when I say unregulated, not regulated by a systemic risk regulator, if they're not too big and they don't sell insurance. Other than the bond rating agency problem Mr. Ackerman pointed out, I think one of the key problems that got us into this mess is that companies issued insurance on portfolios without insurance regulation or insurance reserves. And we discovered that a credit default swap is just as risky as earthquake insurance sold in the San Fernando Valley. I'm concerned that we're seeing taxpayer money transferred to Wall Street based on the political power of the entities involved. We just saw $20 billion transferred to the AIG counterparties, including billions of dollars of billions of taxpayer dollars transferred to foreign entities. And we are, in effect, providing federal insurance to the general creditors because the counterparties of AIG have more political power than the uninsured depositors at IndyMac Bank. I look forward to matching regulation and with the needs of the market without seeing us prevent venture capitalists and others from providing some of the benefits of cowboy capitalism that we've enjoyed, particularly in my state of California. I yield back.
Thank you very much, Mr. Sherman. And now we'll hear from the gentleman from Texas. Oh, I'm sorry, from Georgia, Mr. Price, for 2 minutes.
Thank you, Mr. Chairman. Certainly everyone on this committee believes that our existing financial regulatory structure has gaps, but that doesn't mean that more regulation will be better or that it is possible to create an effective systemic risk regulator to prevent financial crises down the road.
Do you want to substitute something?
What industry is more regulated than the U.S. financial industry? Despite layers of regulation, we still find ourselves in the midst of a major economic contraction. We ought not lose sight of this fact as we consider the best way to regulate while preserving a growing and globally competitive U.S. market that will attract investors. The idea of a systemic risk regulator raises real concerns. If a specific institution is designated as systemically significant, it sends the message that the government will not let it fail. This clearly gives these institutions a huge competitive advantage over non-systemically significant institutions that will be unable to benefit from the implied federal backing. This classification takes us even further into a political economy where the government picks winners and losers, not a market economy where the wonder of America thrives. To quote AEI's Peter Wallison, if we go forward with this idea, we'll be creating an unlimited number of Fannie Mae's and Freddie Mac's companies that are seen in the market as ultimately backed by the federal government. Given the fact that the government actually had to take over these entities because they were so unstable, I don't believe that we should use them as business models for success. This reminder should caution all of us as we consider a proposal that will completely change the way our financial system operates and is regulated. I look forward to an open, honest, and vibrant debate as we move forward. I thank the chair.
Thank you very much, Mr. Price. And now we'll hear from the gentlelady from Illinois, Ms. Bean, for 1 minute.
Thank you, Mr. Chair. Thank you for holding today's hearing and yielding me the time, and to those of our witnesses who are here to testify and share your subject matter expertise, we greatly appreciate it. Last fall, we learned the dangers of allowing antiquated, inefficient regulation of our financial system, and we've all suffered the consequences. And while there's a difference in viewpoints on what actions are necessary moving forward to stabilize our financial system, most of us agree that we need to create a systemic risk regulator who can monitor the financial data of industry players and positions to prevent systemic-wide risk. The values of our portfolios, homes, and businesses are in decline, and there's no question that in good part the lacking federal oversight from a regulatory level has contributed, whether you're talking about the roughly $62 trillion unregulated credit default swap market, or whether you're talking about the complex and growing insurance industry as an important financial service sector player lacking any federal oversight as well. So moving forward, I think the most important thing we can do is make sure we have a regulator in place who can detect and prevent potential risks and work to make sure that one financial service product, player, or sector's downturn doesn't turn into a problem industry-wide. Thank you. I yield back.
And now, thank you, Ms. Bean. We'll recognize the gentleman from Delaware, Mr. Castle, for 1 minute.
Thank you, Mr. Chairman. I sort of believe that we should have a systemic risk regulator. I'm not sure I can really define systemic risk as well as I'd like to, or what that regulator should be. I also have questions about whether the Fed should do it or somebody else should do it. But the bottom line is, I think a year and a half, 2 years ago, most of us on this committee couldn't define a credit default swap. There are other leveraged financial investments that we really don't completely understand. I'm not sure that the regulators who are looking at bottom line accounting numbers in the various institutions really understood all that as well. And I think the bottom line is you need somebody who's looking at the new innovations, those things that are happening economically in our economy. And my sense is this could be a positive step for everybody. And I don't know exactly what the position of all of our witnesses is going to be, but I think we should be looking at this possibility. Maybe the role of the systemic risk regulator should be lesser rather than greater. I don't know what the answer is, but at least information coming from that and letting us know what is going on would be important. I yield back the balance of my time.
Thank you very much, Mr. Castle. Now I'll introduce the panel. Thank you for appearing before the subcommittee today, and without objection, your written statements will be made part of the record. You will each be recognized for a 5-minute summary of your testimony. First, we have Ms. Williams, Director of Financial Markets and Community Investment at the Government Accountability Office. Ms. Williams will outline the results of a study on credit default swaps that I requested last July and which Ranking Member Baucus later joined me. Ms. Williams.
Thank you. Chairman Kanjorski and members of the subcommittee, I appreciate the opportunity to testify before you this morning on systemic risk in general and credit default swaps, or CDS, in particular. While the work we initiated at the request of Ranking Member Baucus and Subcommittee Chairman Kanjorski is the primary focus of my written statement, I would like to highlight a few issues related to systemic risk as well as CDS and the lessons learned from recent events. While CDS have received much attention recently, the rapid growth in this over-the-counter derivative more generally illustrates the emergence of increasingly complex products that have raised regulatory concerns about systemic risk, which is the risk that an event could broadly affect the financial system and ultimately the real economy, rather than just one or few institutions. While bank regulators may have some insights into the activities of their supervised banks that act as derivatives dealers, CDS, like other OTC derivatives, are not regulated product markets, and the transactions are generally not subject to regulation by SEC, CFTC, or any other U.S. financial regulator. Thus, CDS and other OTC derivatives are not subject to the disclosure and other requirements that are in place for most securities and exchange-traded futures products. Although recent initiatives by regulators and industry have the potential to address some of the risks from CDS, these efforts are largely voluntary and do not include all CDS contracts. In addition, the lack of consistent and standardized margin and collateral practices continue to make managing counterparty credit risk and concentration risk difficult and may allow systemically important exposures to accumulate without adequate collateral to mitigate associated risks. This area is a critical one and must be addressed going forward. Gaps in the regulatory oversight structure of and regulations governing financial products, such as CDS, allowed these derivatives to grow unconstrained and little analysis was done on their potential for systemic risk. Regulators of major CDS dealers may have had some insight into the CDS market based on their oversight of the entities, but they had limited oversight of non-bank market participants such as hedge funds or operating subsidiaries of others like AIG Financial Products, whose CDS activities appear to have contributed to its financial difficulties. This fact clearly demonstrates that risks to the financial system and even the economy can result from institutions that exist within the spectrum of supervised entities. Further, the use of CDS creates interconnections among these entities, such that the failure of any one counterparty can have widespread implications regardless of its size. AIG Financial Products, which had not been closely regulated, was a relatively small subsidiary of a large global insurance company. Yet the volume and nature of its CDS business made it such a large counterparty that its difficulty in meeting its CDS obligations not only threatened the stability of AIG, but of the entire financial system. In closing, I would like to briefly mention that the current issues involving CDS have taught us about systemic risk and our current regulatory system. The current system of regulation lacks a clear mechanism to effectively monitor, oversee, and reduce risks to the financial system that are posed by entities and products that are not fully regulated, such as hedge funds, unregulated subsidiaries of regulated institutions, and other non-bank financial institutions. The absence of such authority may be a limitation in identifying, monitoring, and managing potential risks related to concentrated CDS exposures taken by any market participant. Regardless of the ultimate structure of the financial regulatory system, a system-wide focus is vitally important. The inability of regulators to monitor activities across the market and take appropriate action to mitigate them has contributed to the current crisis and the regulator's inability to address its fallout. Any regulator tasked with a system-wide focus would need broad authority to gather and disclose appropriate information, collaborate with other regulators on rulemaking, and take corrective action as necessary in the interest of overall market stability, regardless of the type of financial product or market participant. This concludes my oral statement, and I would be happy to answer any questions at the appropriate time. Thank you.
Thank you, Ms. Williams. Next, we have the distinct honor of hosting our subcommittee former chairman, the Honorable Richard H. Baker, President and Chief Executive Officer of the Managed Fund Association. Welcome, my friend. The floor is yours.
Thank you, Mr. Chairman. I am honored to be here, and I want to specifically note Mr. Ackerman's kind affirmation on the record that I have not spoken to him for a year. That could be of value going forward. For the record, it's been a year and 1 month since my retirement, and I am delighted to be back and engage my former colleagues in discussions as we go forward. Mr. Chairman, Ranking Member, I'm here today in my capacity as President and CEO of the Managed Funds Association, which represents the majority of the world's largest hedge funds and is the principal advocate for sound business practice among my members. Over the last several months, our members have engaged in significant discussions on many of the topics that are of interest to members of this committee. First, a word about our industry. Hedge funds do provide liquidity to markets, enable effective price discovery, and provide capital for businesses to succeed and grow. We also provide risk management tools to sophisticated investors, such as managers of pensions and endowments. To perform these tasks, our funds require sound counterparties and stable market conditions. The current lack of certainty with regard to large financial institutions inhibits investors' willingness to put capital at risk in such market conditions. Establishing a regulatory system that will aid in restoration of market stability will be a service, I believe, to all market participants. I must also state that the current market circumstance was not initiated in proximate cause by our members, and in fact, some of our members are just as adversely impacted as any other investor in the market. In many cases, our members have been a vital source of liquidity in these times in helping to establish a supportive floor of value in a declining market. Notwithstanding these facts, the association believes that smart regulation will improve overall functioning of the financial system. Regulation by itself, I would quickly add, however, is not sufficient, as past circumstances have clearly demonstrated. Our own industry best practices, which have been developed over years of market observation by the MFA, coupled with appropriate investor due diligence, will promote efficient capital markets, market integrity, and provide needed investor protection. Over the last several months, our members have engaged in discussion of what constitutes an appropriate systemic risk regulatory framework. Effective systemic risk regulation would require oversight of the entire financial system. A single regulatory entity should perform this task. Multiple systemic risk regulators would likely have coverage gaps or worse, overlapping and duplicative examination. To provide this regulator with the appropriate data for this enormous task, MFA supports confidential reporting to a systemic risk regulator of the required information. The substance of that report should be left for the regulator to determine, and not, Mr. Chairman, established by statute. And that should be warranted by the current economic conditions at hand for the purpose of assessing a systemic risk potential. This authority should also enable a forward-looking capability, as waiting till the adverse event has occurred will protract time for recovery. We believe granting broad authority with respect to information reporting, along with ensuring the regulator has sufficient resources to conduct effective analysis, is an appropriate construct. It is essential, however, that with such a broad grant of authority for reporting virtually any aspect of financial conduct deemed appropriate, that this disclosure be granted full protection from public disclosure. This can be done and must be without any adverse effect or in any manner inhibiting the ability of the regulator to conduct its important work. We also believe it is very important to establish legal clarity in this role of the regulatory mission. It is our recommendation the singular duty of this office is to preserve and protect the integrity of the financial system. Market integrity and investor protection would remain the responsibility of the current regulatory entities. Further, the systemic risk regulator should not focus on preventing the failure of any single firm, unless it is determined that such failure would precipitate systemic consequences of grave concern. Authority to prevent systemic risk should be exercised very carefully, as not to create the moral hazard from the appearance of an implied government guarantee against future failure. Systemic risk concerns may arise from a combination of factors. Therefore, the regulator should implement its authority by taking an approach that focuses on all relevant sectors of the financial market as well as product. The regulator would therefore need clear authority to seek to prevent systemic risk in a forward-looking manner, to address systemic concerns once they have been identified without hesitation, and to ensure that a failing firm does not threaten the financial system in a systemic manner. Mr. Chairman, we are committed to being a constructive voice in this ongoing discussion, which we recognize will be difficult and complicated, but we stand ready to cooperate, and we look forward to responding to your questions.
Thank you, Mr. Baker. Next, the Honorable Steve Bartlett, President and Chief Executive Officer of the Financial Services Roundtable, is here to discuss perspectives on the systemic risk, and especially with regard to the insurance industry. And I may add another former member that we welcome back. Steve.
Chairman Kanjorski and Ranking Member Garrett and members of the committee. There are no end to the theories and proposals as to exactly how to start the economic recovery, but the fact is that America's economic recovery will start here with the financial services industry, and in some ways it starts today with this committee. The recovery starts with every new loan, with every new mortgage, with every mortgage modification, with every addition to a retirement portfolio. Most importantly, it starts today with a strong, stable financial services sector and a coherent foundation of a consistent and coherent regulatory structure. Our current regulatory non-systemic structure, Mr. Chairman, was created in 20 separate pieces of legislation beginning in 1913, including 1933, 1934, 1989, 1999, 2003, and so on, in a way that often added another agency, structure, or feature often unrelated to the previous structure. To say that the financial regulatory system is fragmented and uncoordinated would be an understatement. By 2008, the weight and inconsistency of the patchwork system could bear it no longer. So on that note, the Financial Services Roundtable recommends that the Federal Reserve be created as a systemic risk regulator, but that would not be a super regulator or a new regulator or a regulator of individual institutions, and that it not be merely bolted onto the existing chassis, as has happened so often in the past, but rather to be integrated into the system. Webster's defines systemic as related to a system, and that should be the test for this committee. Roundtable's proposed structure, systemic restructuring, includes the following. First, by statute, expand the membership of the executive order agency called the President's Working Group, which has the right idea but no authority, and rename it the Financial Markets Coordinating Council. The council should serve as a forum to coordinate national and state financial regulatory policies. Second, the Federal Reserve be designated by statute as the market stability regulator, with NIFO, what's called in corporate board governance work, NIFO, or nose-in, fingers-out authority. The Fed would be authorized to act only through federal prudential supervisors and not unilaterally. The Fed would be entitled to receive information from those primary regulators and act jointly through them when sanctions are required. The definition of systemic risk should not be size-based and thus avoiding the too-big-to-fail syndrome. Rather, systemic risk would be any risk to the broader system that can arise from the collective actions of hundreds or from significant actions of a few. For example, recent example, a combination of bad underwriting of mortgages, mortgage insurance without proper reserves or oversight, securitizations based on credit ratings alone, little due diligence for mortgage-backed securities pools, and off-balance sheet vehicles combined collectively or systemically to create this systemic risk that we're now suffering from. And that was across several, perhaps hundreds of regulatory agencies. The Fed would not be a super regulator, but would work with and through other regulators. The only exception would be in the event of a well-defined emergency. And that leads to a related point. A market stability regulator does indicate the need for a national insurance regulator. The Fed should work through a national insurance supervisor, not in a vacuum. A market stability regulator, to reduce risk, creates the additional need for a national insurance regulator to gather information and to act upon risky market activities in the federal space in a timely and uniform manner. The third part of this is to consolidate existing federal prudential supervisors such as the OCC and the OTS into a single national financial institutions regulator. The new agency would be a consolidated prudential and consumer protection agency for banking, securities, and insurance. Fourth, create the National Capital Markets Agency through the mergers of the SEC and the CFTC, and use that, to the point that was made earlier, to supervise or to oversee FASB jointly with the Federal Reserve. And fifth, create the National Insurance and Resolution Authority for depository institutions from the basis or the foundation of the FDIC to create a uniform and coherent way of disposing of failed institutions. And finally, we propose that the current Federal Housing Finance Agency remain in place temporarily, pending a full review of the role and structure of the housing GSEs at a future but a near term. Mr. Chairman, thank you for the opportunity to discuss this overwhelming need for a market stability regulator as a necessary first step in a broader reform of our financial regulatory structure.
Thank you very much, Mr. Bartlett. And next we'll hear from Dr. Teresa Vaughn, Chief Executive Officer of the National Association of Insurance Commissioners. Dr. Vaughn.
Chairman Kanjorski, Ranking Member Garrett, and members of the subcommittee, thank you for inviting me to testify before the subcommittee on systemic risk. My name is Teresa Vaughn, and I'm the Chief Executive Officer of the National Association of Insurance Commissioners, or NAIC. Prior to joining the NAIC, I was a professor of insurance and actuarial science at Drake University, where I focused on the management and regulation of financial institutions. From 1994 to 2004, I was the insurance commissioner in the state of Iowa, and I was the NAIC president in 2002. I'm pleased to be here today to discuss the NAIC's activities in the area of financial stability regulation and to offer our assistance and expertise as the committee tackles the enormous challenge of developing legislative solutions to the current financial crisis. The NAIC is a full partner with Congress and the administration in seeking ways to improve the financial regulatory system and promoting financial stability. The state-based insurance regulatory system is one of critical checks and balances. We have a long history of consumer protection, solvency, oversight, and market stability, so any system of financial stability regulation can and must build on this proven regime. While the current financial crisis illuminates the need for review of regulatory oversight, consumer protections and prudent solvency oversight must not be compromised in the effort to improve or enhance financial stability. In our view, an entity poses systemic risk when that entity's activities have the ability to ripple through the broader financial system and trigger problems for other counterparties, such that extraordinary action is necessary to mitigate it. The nature of the insurance market and its regulatory structure makes the possibility of systemic risk originating in this industry less than in other financial sectors. The insurance industry is more likely the recipient of systemic risk from other economic agents rather than the driving force that creates systemic risk. Most lines of insurance have numerous market participants and ample capacity to absorb the failure of even the biggest market participant. If the largest auto insurer in the U.S. were to fail, its policyholders would be quickly absorbed by other insurers and backed up further by the state guarantee fund system. This would not pose systemic risk, as the impact is isolated, does not ripple to other financial sectors, and does not require extraordinary intervention to mitigate. Risks in insurance are different from bank risks for three reasons. First, insurers tend to be less leveraged than banks. Second, insurers tend to have liabilities that are different from those of banks, more independent of economic cycles. And third, insurers tend to have a longer time horizon. They typically do not have to sell assets on a regular basis to meet short-term demands. An insurance business having special interconnectedness to capital markets may be capable of generating systemic risk. However, the financial and mortgage guarantee lines have been stressed because of their coverage of mortgage-related securities. And, as has been well documented, large, complex financial institutions with insurance operations, like AIG, have produced systemic risks within the economy. The insurance businesses in these holding companies have thus far been adequately protected by state insurance regulators. State insurance regulators recognize that action is needed at the federal level to identify and manage systemic risk within the nation's financial marketplace. That should not be misconstrued, however, as simple acquiescence in our part to preemption. Recognizing the critical need for action in this area, the NAIC has developed a series of principles for systemic risk regulation as it relates to insurance, which we believe must be incorporated into any comprehensive systemic risk system. Our principles recognize that greater collaboration among financial services regulators is needed, preserving the principle of functional regulation. Any framework established to regulate financial stability must integrate but not displace the successful state-based system of insurance regulation. A federal financial stability regulatory scheme must provide for sharing of information and formal collaboration among all financial regulators. In consultation with functional regulators, any financial stability regulator should develop best practices for systemic risk management. Preemption of functional regulatory authority, if ever appropriate or necessary, should be limited to extraordinary circumstances that present a material risk to the continued solvency of the holding company or threaten the stability of the financial system. For more than 150 years, state insurance regulators, working together with state legislators, have continued to improve, enhance, and modernize state-based insurance regulation for the benefit of consumers and industry alike. We want to bring the best regulatory minds to bear on the challenges ahead and to serve as your resource as you navigate and analyze the current financial landscape. I thank you for the opportunity to testify, and I would be happy to answer any questions.
Thank you very much, Dr. Vaughn. And next we'll hear from Mr. Robert A. DiMuccio, President and Chief Executive Officer of America Mutual Group, on behalf of the Property Casualty Insurance Association of America. Mr. DiMuccio.
Thank you, Mr. Chairman. I thank you and members of the subcommittee for this opportunity to present the PCI solutions for addressing our systemic risk crisis, and thank you for your leadership and that of your colleagues. I'm appearing on behalf of the PCI, the leading property casualty insurance trade association, representing more than 1,000 insurers in different lines and sizes. I will address 3 points: the definition of systemic risk, two, that systemic risk legislation should be the critical first priority addressed to prevent another economic crisis from recurring, and how a systemic risk overseer would function. PCI has defined systemic risk of a financial institution as the likelihood and the degree that the institution's activities will negatively affect the larger economy, such that unusual and extreme federal intervention would be required to ameliorate the effects. Or simply stated, if the government has to step in to bail out a company to protect the larger economy, that's a systemic risk. Traditional antitrust analysis focuses on too big to fail. Recent government intervention decisions have shifted towards too interconnected to fail, which is measured by the degree a company's activities are leveraged throughout the economy such that its impairment would cause additional failures, and the extent to which its failure risk is correlated with other systemic downturns. For example, even a large auto insurer failure would not create a ripple effect of company failures. Its market share would be quickly absorbed by competitors. Conversely, some small credit default providers have highly leveraged counterparties with recessions increasing default rates and provider impairment exacerbating the recession. My written testimony lists the systemic risk characteristics of the different lines of property and casualty insurance, and a similar analysis could be applied to other financial products. To address the current economic crisis, restore investor confidence, and prevent another economic disaster from occurring, a systemic risk overseer should be created. The Federal Reserve Board should serve as the systemic risk overseer, as it has the appropriate mission and expertise. However, the Federal Reserve Board's systemic risk oversight should be completely separate from other bank holding company oversight powers. Jurisdiction would include any institution engaged in financial activities that in aggregate present a significant systemic risk. Also included would be any institution engaged in financial activities that chooses to submit to federal systemic risk oversight, such as for international equivalency treatment. Systemic risk oversight powers should be flexible and include the authority to require the following: appropriate transparency and disclosure to overseers for all entities within the regulatory jurisdiction, escalating information sharing with other U.S. and international overseers as a company's systemically risky activities increase, and risk management for specific entities whose financial activities present a significant systemic risk. However, systemic risk oversight powers would not include the following: solvency oversight for individual companies, business conduct oversight such as licensing, market conduct, or product approval, duplicative disclosure or transparency information requirements, general federal compliance such as privacy standards, and other elements of bank holding company oversight. Regarding oversight of risk management, oversight standards could consist of overseeing holding company capital standards and group risk management, monitoring of affiliate transactions and significant off-balance sheet obligations, collecting and sharing information related to group systemic risk and holding company solvency, requiring coordination of examination and visits regarding systemic risk, and eliminating duplicative oversight of holding companies. PCI proposes increasing coordination to detect fraud and improve early risk monitoring through enactment of the Financial Services Anti-Fraud Network that passed the House in 2001. PCI also proposes requiring the Presidential Working Group on Financial Markets to implement limited information sharing coordination with international overseers regarding potential threats to cross-border market stability. These proposals are practical solutions to solving the systemic risk crisis that do not require a vast new bureaucracy. It does require filling regulatory gaps. 3 final points. To address congressional imperatives, larger regulatory reform and oversight could be analyzed in a second phase. We should not confuse solvency with systemic risk. Solvency regulation is best done by functional regulators to ensure that companies have sufficient capital to fulfill their promises. Systemic risk regulation is macro oversight to prevent holding company failures from contaminating other markets in the larger economy. Merging solvency regulation into systemic risk oversight will simply create a regulator who is too big to fail. PCI is committed to working with this committee in advancing appropriate solutions to stabilize the markets and prevent another economic crisis from occurring. Addressing systemic risk is the best action to do so, and we stand ready to assist in any way. And I thank the committee for their time and will be willing to answer any questions.
Thank you, Mr. Demuccio. And now we'll hear from Mr. Timothy Ryan, Jr., President and Chief Executive Officer of the Securities Industry and Financial Markets Association. Mr. Ryan.
Thank you, Mr. Chairman and members of the committee. The purpose of my testimony will be to detail SIFMA's views on financial market stability regulator or systemic regulator, including the mission, the purpose of such a regulator, and to highlight certain powers and duties that you might want to consider providing to such a regulator. Surely. Is that better? Systemic risk has been at the heart of the current financial crisis. We at SIFMA have, through committees of our members and roundtable discussions with experts, devoted considerable time and resources to thinking about systemic risk and what can be done to identify it, minimize it, maintain financial stability, and resolve a financial crisis in the future. Through this process, we have identified a number of questions and trade-offs that will confront policymakers in trying to mitigate systemic risk. Although our members continue to consider this issue, there seems to be a consensus that we need a financial market stability regulator as a first step in addressing the challenges facing our overall financial regulatory structure. At present, no single regulator or collection of coordinated regulators has the authority or the resources to collect information system-wide or to use that information to take corrective action across all financial institutions and markets regardless of charter. We believe that a single accountable financial market stability regulator will improve upon the current system. While our position on the mission of the financial market stability regulator is still evolving, we currently believe that its mission should consist of mitigating systemic risk, maintaining financial stability, and addressing any financial crisis. In my prepared remarks submitted to the subcommittee, I have provided an outline of certain powers and duties the financial market stability regulator might have and some issues you might want to consider in determining the scope of those powers and duties. I will briefly touch on those powers and duties, but note that my prepared remarks provide a very full discussion of these issues. The financial market stability regulator should have authority over all financial institutions and markets, regardless of charter, functional regulator, or unregulated status. In carrying out its duties, the financial market stability regulator should coordinate with the relevant functional regulators as well as the PWG in order to avoid duplicative or conflicting regulation and supervision. It should also coordinate with regulators responsible for significant risk in other countries. It should have the authority to gather information from all financial institutions and markets, make uniform regulations related to systemic risk that are binding on all, and act as a lender of last resort to all. It should probably have a more direct role in supervising systemically important financial groups, including the power to conduct examinations, take prompt corrective action, and appoint and act as the receiver or conservator of such systemically important groups. These more direct powers would end if a financial group were no longer systemically important. There are a number of options of who might be the financial market stability regulator. Whoever is selected the financial market stability regulator should have the right balance between accountability to and independence from the political process. It needs to have credibility in the markets and with regulators in other countries. It should have the tools necessary to identify systemic risk, take prompt action to prevent a financial crisis, and to resolve a financial crisis if it occurs. To be truly effective, the financial market stability regulator would need to have the power to act as the lender of last resort or to provide emergency financial assistance to the markets and have prompt corrective action and resolution powers over failed or failing financial institutions that are systemically important. And I stand ready to answer any of your questions, Mr. Chairman and committee. Thank you.
Thank you, Mr. Ryan. I thank the panel for their testimony. I'm sure we all have some interesting questions. Let me start off with my questioning period. The thing that sort of disturbs me, my ranking member referred to in his opening remarks, and that is we've got to get this one right. We can't just hurry to expeditiously conclude something or pass something that appears to be a fix when in fact it doesn't really accomplish something of a significant nature. And the thing that disturbs me is trying to get my arms around the idea of just what is systemic risk. We've all talked about it, I assure you, and we've heard you. But I think when the question came up in 1964, Justice Potter Stewart, in trying to explain what was obscene, he said the following: I shall not today attempt further to define the kinds of materials I understand to be embraced, but I know it when I see it. And I think probably it was systemic risk. After the fact, we seem to all know it when we see it, but before it arrives, we have no idea, because if you make the proper conclusions, we wouldn't be in the crisis we're in today if people could have readily seen that systemic risk would have occurred. We certainly have enough regulators that had eyes on the situation. It's just they weren't analyzing or seeing the situation. Now, I myself think that we have in the past constructed some interesting areas, some of which now have been passed over, but the prior practice of the Justice Department to honestly decide whether or not there were antitrust violations and reviewing mergers and consolidations with that in mind, very often accomplished proactively responding to something before it happened or before it caused the occasion to cause something monopolistic or otherwise to occur in the system. That's what we're attempting to do. When I think of it, in most instances, in our government at least, we regulate entities. We don't regulate conclusions or finalities that occur. When you think of it, almost anything could be a systemic risk. I was just talking to my staff back here, and I said, if you really think about it, a bad virus could be a systemic risk. Obviously, we're not going to try and regulate viruses so that they don't cause systemic risk. But on the other hand, I see a big challenge ahead of us, and that's why I agree with the ranking member. You know, we're treading very closely to government authority to encompass regulation of everything, and under the excuse that it may grow into systemic risk, therefore we have the right to inquire into it, and possibly by act of Congress we have a right to limit or control that action. That seems to be an unusually extended role of government, and we have to be very careful we don't carte blanche offer that. On the other hand, if we don't do something that's severe, we're going to run into the same problem we're in now in terms of allowing things to grow. I just point out to the panel, we had the automobile industry here several weeks ago, and their argument to a large extent was that they constituted a systemic risk, in that if the United States government allowed any one of the three American auto companies to fail because of their intertwined nature of having similar dealers and similar suppliers, those suppliers or dealerships would fail and therefore it would fail for all three of the auto companies, not just for the one that had to go into bankruptcy, and that would constitute a systemic risk for the auto industry, and it makes sense. Now, could we have stopped that from happening? Would we have anticipated that? Is there some magnificent character out there who has the brain power to anticipate all those realities? And I'm not even certain in the auto industry that was controlled by a thinking power. I think it just occurred. And is that what we're talking about with systemic risk? And now adding on this feature of going to a global economy, this is a frightful thing. I think you have a good idea there, Scott. We've got to take our time. We've got to make sure we get this right. Could some of the members of the panel give me an idea? Do you see a very grave difficulty in defining what is systemic risk and what part of that risk we really want to pay attention to in the nature of creating some laws? Mr. Bartlett.
Yeah, Mr. Chairman, I don't think it will be difficult. It will require some thought by the committee as you have and by others. I think it's not difficult so long as the committee is looking for a systemic pattern, and then the regulation is still by the principal supervisor, by the primary prudential supervisors at the national level. So I heard the consistency on the panel that there's no call here for a new regulator or a super regulator to take the place, but rather someone to connect the dots. Now, clear example of there were hundreds of regulators regulating thousands of regulated banks and tens of thousands of non-regulated mortgage originators, and those regulators collectively and individually concluded that those things that were called subprime mortgages were unsafe and unsound and bad underwriting. But they had no connection back upstream to Wall Street to say, by the way, these, and so the regulators said, well, you can't own them. So they didn't own them, they sold them. But there was no connection then to the rest of the system to say that somebody down here has concluded that they were unsafe and unsound. So it's that connecting the dots system that we're calling for, not a new regulator.
Well, Ms. Bartlett, though, to connect those dots, wouldn't that encompass authority for the existing various regulators that we have to share information and confidential information with one another? And isn't that sort of dangerous? Isn't that what we would worry about?
Mr. Chairman, it's not dangerous. It is dangerous not to, and we've discovered that. It does require legislation. Let me say that crystal clear. This cannot just happen because the statutory authority is not there, but it requires the authority of the Federal Reserve and the prudential supervisors to collaborate and share information with one another.
So you would be perfectly agreeable to allowing a set of regulators, if we ever get around to regulating hedge funds, I'm going to pick on Mr. Baker for a second, that the information they would obtain from the various hedge funds around the country as to what their investment policy was, that should be able to be disclosed across the regulatory network.
No, sir. Disclosed to the Federal Reserve or to the Market Stability Regulator, because it's a systemic regulation function. I think you can make other decisions on disclosure and non-disclosure, but the Fed needs the information to know what's going on. The first call on Bear Stearns did not come from the SEC, and it did not come from from Bear Stearns. It came from Treasury that didn't have a regulatory role, and they called the Fed as the systemic regulator, even though there was no statutory mandate for the Fed to be a systemic regulator, but the Fed was all they had. So it was outside the system, if you will.
You're really, though, talking there about the diagnostician, that after a set of facts and circumstances occurred, somebody to blow a whistle, to put the dots, connect the dots, and blow a whistle. But aren't we really talking about someone doing an analysis before the decisions are made to make the review? So we're one step ahead of where it's easier to define what we're doing. Yes,
that is
Mr.
precisely the point. How would Bear Stearns have been different had the Fed been conducting authorized to conduct some kind of systemic risk analysis a year or 2 years earlier? Would it have prevented the crisis? I don't know, but the outcome would have been different, and I suppose, and I think better. The first call that there was a systemic problem came after the horses were out of the barn and running around in the pasture.
Mr. Chairman?
Yes.
May I speak to this briefly?
I'm going to let you speak, but I'm already over my time. But go ahead, Doctor.
Okay, thank you. I used to teach a class at Drake, I mentioned when I started, on the regulation of financial institutions. And one of the things, was a graduate class, and we would spend some time talking about systemic risk. And I find the evolution of this discussion very interesting, because if you look at kind of the way systemic risk was thought about around the time of the savings and loan crisis, way back when, that was very bank-centric. It was because the banks are connected to the payment system, because of the way banks extend credit, that a contagion within the banking system creates systemic risk. When long-term capital management happened, what we saw, we began to think about hedge funds and the possibility for their having systemic risk. And I think what we've learned with AIG is that there is an issue about activities that create interconnectedness, that we have these credit default swaps that it would have been nice if someone had been looking at this and saying, boy, look at the amount of credit default swaps that the banks have, going both directions, and where is this stuff going, and who's watching the way this is playing out through the marketplace, and making a decision as to whether these should be regulated. And it strikes me that going back to your suggestion, that we're talking about someone who is looking at the marketplace and trying to identify problems before they happen. I think that's one of the things that is very consistent with what the regulators have been saying. It's not the only model, but that's consistent with what we have been saying. We have seen, because of AIG, we have a better recognition of how systemic risk impacts our ability to protect our policyholders. So we think it would be helpful to have some mechanism that is monitoring systemic risk within the industry, so that we can work with them to make sure that it's not interfering with our ability to do what we do.
Thank you, Dr. Vaughn. Mr. Garrett.
Thank you all. Thank you, Mr. Chairman. I appreciate your comments with regard to the auto industry and as what the systemic risk is there. I'm thinking at the same time about the technology industries as well, electronic industries. Are there other ones outside of the financial sector that we'd have to begin to throw into this mix, that any one of these could, if they ever were to fail, could have a systemic problem? It was prior to everything blowing up in August of last year when Chairman Bernanke said, with regard to setting up a regulator, some caution is in order, however, as this more comprehensive approach, which has basically been described by some of you, would be technically demanding. He went on to say, we should not underestimate the technical and information requirements of conducting such exercises effectively. I think he hit it right on the point. How do you do that? And when you look to see what the track record has been already for our regulators, well, let's take a look. Who would you suggest that we take to put into this uber sort of regulator, or just a council or what have you? Should we take it from the SEC in light of their experience with the Madoff situation and some of these other situations that they've been involved in? Should we take it from the OTS and with respect to what they've done with the banks and the AIG subs? Should we take it from the Federal Reserve with their experience with setting monetary policy and their experience with the national banks as well? Should those be the people that we are drawing from in order to be able to sit back and get a more comprehensive approach? I mean, on the Federal Reserve, just remember, and I appreciate your comments, Mr. Bartlett, about them looking at one area, but think it wasn't the Boston Federal Reserve back in the early 90s who said that the banks could consider such things as welfare payments and unemployment insurance when they decided whether or not they should be giving bank loans to individuals. So should it be those same individuals that we call upon to be our super regulator in the future to be able to make these decisions? If they were not able to do it for the narrow area that we've charged them with, that they had the authority to do so, who on the panel thinks that we should be drawing from them to be making the decisions for us on an overarching responsibility? You do. Who do you think? Yeah.
Well, Mr. Garrett, I understand your question. The Federal Reserve gathers information and has for a decade on the production and distribution of corrugated box containers to help them with information about the economy and what's happening in the economy. But they're not permitted to gather information about the reserves against the hundreds of billions of dollars of CDS, because that's excluded to them. The Federal Reserve was given the responsibility by regulation, rightly or wrongly, to regulate as a small regulator, HOPA, and they were busy doing that in regulating it as a consumer protection issue when the entire system of subprime mortgages collapsed, because they weren't authorized to look at that system, but they could look at HOPA and consumer protection. So we are not, and I don't believe anyone is advocating an uber regulator or a super regulator. Rather, we're advocating someone to connect the dots.
I understand that, but your experience in Congress in the past, when is it ever the case where you have a regulator in place that does not to try to grow in its extent of authority? Do they ever just sit and say, this is our realm of responsibility here, and we are not going to exert it more so than, is that your experience? Or
That's why God made oversight committees.
Yeah. Ms. Williams, I have a question, and this is, I just need a better picture on this. It's one of the points I just raised, and I appreciate your testimony. When the OTS is out there, and you use the expression making their examinations, and you said they had a problem, not a problem, but they had the aspect that they weren't able to get into the hedge funds, and they weren't able to have information from the AI, more particularly with regard to the AIG situation, as far as their offline business, what have you. Can you, in a sentence or two, elaborate on that? What should have been their authority there? Did they not have the ability to at least look at that and say, here's an area that we know something's going on, but we don't have the authority to look at it? We want to investigate it more, or do they just simply not know that at all?
This is the challenge with holding company oversight, because they have the authority to look at the holding company. In this case, it's a thrift holding company that we were talking about in the case of AIG. They could look at the holding company and any threats to the holding company, but it creates an issue of they can go in if they believe there's a threat to the holding company, but if you aren't looking at all of the subsidiaries within the holding company, how are you going to identify the threat?
Well, could they look at all the subsidiaries?
They have, to the extent that it poses a threat to the holding company, there are specific, cases that they could go in and look at it. And my understanding is that's what they did once the internal auditor raised concerns about risk management of AIG financial products. They went in once those concerns were raised because that raised an issue for the holding company.
I appreciate it. I might want additional questions later. I appreciate it. Thank you, Chairman.
Thank you, Mr. Garrett. Now we have the gentleman from New York, Mr. Ackerman.
Thank you, Mr. Chairman. Before I ask my questions, I just want to respond to some of the things some of my colleagues put forth as statements or theory or postulates in saying that the problem that we face really is there's too much regulation, and some of them said it in different ways. I would just like to analogize that if we had a superhighway system for use of mixed vehicles, different kinds, cars, trucks, etc., and there were speed regulations, a lot of speed regulations, and nobody was enforcing the speed regulations because the state police just neglected to patrol or find anybody who was speeding. And suddenly, systemically, the entire highway system is filled with crashes and carnage. Is the problem A, that there are speed requirements, B, the police are not patrolling, or C, the people trying to figure it out are from outer space? Or feel free to add D, all of the above. I think we're getting into an area here where we're talking about philosophy versus fact. That's my observation. A question. Mark to market. Where there is no market, and arguably sometimes there is no market, how do you require companies to mark down the value of their company, setting off all kinds of crises in the economy, and expect there not to be problems? Anybody?
I'll take a pass at it here, Mr. Ackerman. I come at it from the experience of the savings and loan debacle, the creation of the RTC, and the resolution of property owned by the U.S. taxpayer as a result of closure of significant numbers of institutions. Real property was sold for about 20 cents on the dollar, notes and securities for 12 and 13 cents. It was a contained geographic downturn in Louisiana and Texas, and the residual economic effects of that distressed sale in that environment caused a decade-long downturn in those regional economies. To a great extent, it was brought on by, in essence, a mark-to-market philosophy. Let's get the stuff out the door at a emergency price. At the same time, I would be quick to add, however, efficient market function only comes with accurate disclosure of values. And there will be a very difficult decision to be made by someone in an administrative agency as to how to proceed with government-owned resources in the current environment. If a bank is to liquidate an asset and it is below whatever value is on the books, they'll have to raise capital in a very tough marketplace to offset that material loss. If they expect to have it sold and
which is why the banks are holding on to all that money we gave them.
To a great extent, that is a contributing factor. There would be others better able to respond to that observation than I, but I would also suggest that in order to sell that asset in a difficult market at above book value is very problematic for the acquirer because he knows he's not paying market value. So this is going to be a continued and long-term problem of resolution. I cannot dispute the fact your observations have merit, although I would say that to act without true valuations and allowing parties to come to a negotiated price on any asset disposition, we could not expect that to be the end conclusion either.
Dr. Vaughn?
Yes, if I can just speak to this from an insurance perspective a little bit. I have found myself for the last year or so rethinking myself around this subject of mark-to-market, because I would say that a couple years ago I tended to be thinking that that movement, that direction was a good thing. When you hit a world like we're in today where the liquidity situation is so difficult, and we know that the market values of these assets are depressed for two reasons. One is there are real credit losses coming down the road. But second, there is a depression in market values simply because of the liquidity of the market. We don't know what the mix of those two is. But to force companies that are going to hold these assets long term that don't have to sell in this illiquid market, to force them to write down to a value that reflects current illiquidity, I am wondering, again, just sort of thinking through it, whether it's sending the wrong signal to the marketplace, and particularly I think about consumers. Is it sending the wrong signal to consumers about the capital that is in these companies and how strong these companies are? There's a lot of, one of my colleagues likes to say, the greatest risk we have right now is a crisis of confidence. It's that people are scared, and we know our policyholders are scared, and so that's one of the reasons that the insurance regulators have really been struggling. What kinds of reporting requirements should we be having in this environment right now, where the markets are not anything that we've ever lived with before, and not in my lifetime?
We can't address, or we certainly can't legislate confidence in the market. We're going to do a lot of cheerleading to do that. But in addition to that, if I may, for a couple of seconds, Mr. Chairman, just say that among the risks of the system, I would think you have loopholes which we can do something about, greed which we can do nothing about, and within greed there are things that we can do to eliminate the loopholes, which include things like reinstating the uptick rule, where people, for reasons of their own, beat down the value of a company to take advantage of the system to make lots of money, while distorting the real value that there might be in a company or in the marketplace. Thank you, Mr. Chairman.
Thank you very much, Mr. Ackerman. And now we'll hear from the ranking member of the full committee, Mr. Baucus.
First of all, let me commend Director Williams for your report. Now, I mentioned all the committee members that Mr. Kanjorski and I requested a GAO study on credit derivatives, and more specifically CDSs. And this report was actually filed today, and that's what she was giving testimony about. So it's something I direct all our attentions to. Let me make one comment, and then I'm going to ask questions. Heard a lot of Mr. Royce and Mr. Bartlett. You both call for federal regulator for insurance. And I think at least implied in those was that the regulation in insurance had failed. But I really don't see any evidence of that. Our national insurance markets are the strongest component of our financial services market now. If they're having problems, and they are, it's because of the economy, it's failures in the banking system and other parts of our financial system. In fact, we talked about, one member specifically said the failure of insurance regulators to do anything on AIG. Well, that was actually that was an alternative investment vehicle that operated really the only regulation you could say of that. It was in London, 300 employee group, AIG Financial Products. There was no insurance regulation of it because it wasn't an insurance business. I mean, you could say CDSs are, but the only federal regulator was a regulator for a holding company, and that was a bank regulator. It wasn't an insurance regulator. So I'm not sure that, other than New York with the bond insurers, that you could, I mean, I can find literally thousands of instances where we had failures in our bank regulators, but I find very few in insurance. So I'm not sure that, that's a very fair argument to say that what's happened. In fact, I think what's happened has shown that probably our state insurance regulators have done a better job than most everybody else. And now we're probably we're asking the Fed, and I think, Mr. Bartley, you'll agree that the President's Working Group in, 1988? And then this Congress in 1991 actually directed the Treasury and the Fed to look at systemic risk and see what sort of powers they ought to have to deal with it. And now we're going to appoint the Fed. So I would associate myself with Mr. Castle's remarks, I think, most closely, and Mr. Price's, as to how we address this systemic regulator. We ought to have one. We ought to have we ought to have systemic risk. But the Congress said that in 1991, a year before I got here. Having said that, are any of you troubled by giving the Fed so much power? I mean, they've got already important their monetary policy right now. I mean, does that get into... And if they're regulating somebody, but they're also giving the right to, as some of you said in your opening statements, to bail them out. I'll use that word. You didn't use that word, but some of you did use rescue. They do have they've been rescuing one institution after another, so I think we'll all agree. Are you troubled by that, Mr. Vaughn? I think no, Dr. Vaughn, I'm gonna ask Mr. Ryan. I know how you feel. Mr. Ryan?
I'd like to, first of all, make a general comment.
Yeah.
And maybe I'm dirtied up because I was the director of the OTS, first director of the OTS. But as a former federal bank regulator, I can tell you, and this is true basically of all former bank regulators, you can take them from all over the globe. Right now, as the chairman said, we know what systemic risk is, and we're living through it right now because we see it. We know that there is no federal regulator fully equipped with the tools and the information to help us avoid this type of problem in the future. Because what we're looking for here is we're looking for someone who has the tools, has the information, has the power to hopefully look a little bit over the horizon. Bank regulators are rear view mirror type people. It's all looking back. And the markets, that's why we call it not systemic risk regulator, we call it a financial market stability regulator. That's what we want this entity to do.
Sure.
We need someone to do that job.
But I guess what I'm saying, Mr. Ryan, should it be the Fed to do all of that?
That's why we haven't really decided that, Mr. Bacchus.
Okay.
That's why we kind of dodged that. We think I think having all these hearings, that's why every time you have a hearing, I'll come. Any one of these committees, I'll come, because we need input, and you all need to make a decision in a timely fashion. And to me, that's before the end of this year, because we need a restoration of confidence, and a component piece of the restoration is having a regulator that can do this job.
Sure. And let me go back and say this. If you look at most of the institutions that failed, they were not regulated at all. I mean, option one, country, they weren't, they were non-banking affiliates, but they weren't insurance affiliates. So they really were non-regulated institutions. Even GEs, they had a non-regulated WMC. You can just go down the line, and probably 70% of the losses were in companies that were not regulated by bank regulators or insurance regulators. So, I mean, those are the gaps.
We've talked about the shadow banking system and basically unregulated. We need someone who can look over the horizon, not limited by charter, and can pull the information together and then take action. And the action, as I said in my testimony, goes from the more simplistic setting standards to also the resolution.
Right. And let me say this, and Mr. Dr. Vaughn, I'm not trying to, but I know how you feel. I think I was favorable to your point of view, right? So, what about, as opposed to rescuing this institutions, what about two options? One, it would be an orderly liquidation. Two would be not allowing them to become a systemic risk. Wouldn't that be aren't those two better options than injecting taxpayer dollars or guarantees into the system?
Mr. Backus, that's what we're proposing. The Fed has a lot of power, but they don't have the power to prevent. They're called upon, whether they have the statutory power or not, they're called upon to resolve with a lot of money, but they didn't have the power to prevent.
All right. Could Dr. Vaughn just briefly respond? I want to my first question. You wanted to answer the first one. I'm sorry.
The first one, oh, good. Not to the question about whether we should put taxpayer money into.
Or whichever one you.
No,
want.
I'd rather do the first one. Thanks.
Okay.
I appreciate that, because it gives me a little bit of an opportunity to make a couple points I wanted to make. First of all, the discussion about creating a federal regulator a couple years ago when I was an insurance commissioner was all about efficiency, the inefficiency of the state system. And I find it interesting that suddenly this has morphed into we need a federal regulator so that we have effective insurance regulation, when, as you pointed out, there's no evidence that the system has not been effective. And in fact, we don't have any policyholders that have lost any money yet. We have the credit default swap problem was not in the insurance company because we wouldn't let them do it in the insurance company. So we were regulating that company to protect policyholders. And unfortunately, we're getting hit by things outside the system. Now, the point I wanted to make is that this idea of creating one uber regulator, we are absolutely not in favor of that, absolutely opposed to that. We do not want a system that preempts our ability to protect our policyholders, and we think that a system of checks and balances is a very good thing, and that having a lot of eyes on the problem is a very good thing. And the story that I have told many people in the last couple of weeks is that what has happened in the world over the last couple of years has crystallized for me an appreciation of the fact that regulators make mistakes. I think that is the most important lesson we can draw from this. Regulators will make mistakes. A regulatory system will fail. And when you build a regulatory system, you should build that to withstand those kinds of failures. Bernie Madoff was a big failure. And I am absolutely not pointing fingers at the SEC for that failure, because I'll tell you, the insurance regulators have had failures also. And, we have been the recipient of several GAO studies, thank you very much, that pointed to problems in our system and that we then went and fixed. But the point is that when we have our Bernie Madoffs, and my example is a guy by the name of Martin Frankel, who, while I was an insurance commissioner, took control of 7 insurance companies. He was a fraudster. He began bleeding the insurance companies, stealing money from them. He got through several insurance commissioners, and when he got to the state of Mississippi, which was maybe the 4th state he got to, Commissioner George Dale of Mississippi looked at it and said, "This doesn't look right," and he brought him down. What that illustrates to me is the value of having multiple eyes on the problem. And that's what we have in the state system, is multiple eyes on the problem. We don't want our eyes taken away when you build this system. If you want to add another set of eyes, that's great, but don't take our eyes away in our ability to protect our policyholders.
Thank you very much, Doctor. Appreciate it. We have a vote on it. As I understand it, we have 4 votes. 3 votes, I'm sorry. But we have at least 5 minutes that we can have Mr. Sherman get his examination before we recess.
Thank you. I'll start with kind of a rhetorical question that you should respond to for the record. A number of those on the other side of the aisle have said, wait a minute, you get this systemic risk regulator, and those big enough to be subject to it get this implication of federal stamp of approval. Maybe they're viewed as too big to fail, which means that they'll get bailed out. And this gives them an advantage in the marketplace, lower interest rates, and worst of all, if they do need to get bailed out and there's an implication that we're going to bail them out, we might bail them out. So one issue is, if instead of having too big to fail, regulating it in a way that has all the problems that are pointed out by our Republican colleagues, we could prohibit too big to fail. Say any financial institution over $250 billion in size, that's as big as you get. It's time to give your shareholders the joy of a spinoff. And we do not have to put ourselves in a position where we have to endure too big to fail, or we have to insure too big to fail. I'd now like to shift to AIG, which recently transferred, I believe it's $20 billion of our money to their counterparties as cash collateral. I'm going to ask first Mr. Bartlett, what portion of those counterparties are likely to be foreign entities? You have an understanding of the customers that AIG would have had for its credit default and similar products. Should I, as a taxpayer, assume that a substantial portion of that is going to foreign entities?
I have no idea, Mr. Chairman. It's a global market.
The global market in which the rest of the world is a very substantial part.
And we're a substantial part of the rest of the world also. So I don't know.
So we would expect that if you're sending $20 billion to AIG counterparties, you're sending a lot of it overseas. Dr. Vaughn, I realize that the AIG entity involved is the one non-insurance AIG entity. Do you have any understanding as to what portion of that money would have been going overseas?
I really do not.
Okay. Dr. Vaughn, if I went to an investment house and I said, your building may burn down and that could be a problem for you, you'd probably say, and I'll offer you insurance against that risk, you'd probably say I'd have to get registered with my state insurance and have reserves and really be an insurance company. But if I go to them and say, your portfolio may burn down, apparently I don't need an insurance charter. What is the definition of insurance under the various state laws that says that insuring a portfolio isn't subject to state regulation, when clearly most investment houses were more worried about their portfolios burning down than their buildings burning down?
That's a very interesting question that you raise, and one that there's a fair amount of discussion going on right now in regulatory circles. At one point, recently the New York superintendent has suggested that a credit default swap that was actually covering a portfolio, that was insuring a portfolio, would be treated as insurance. Many of what is being transacted, however, are what you call naked credit default swaps, where there's no underlying asset that's being, quote, insured.
Well, wait a minute.
Yeah.
If I go, if I sell life insurance to somebody on somebody's husband,
Right.
They've got an insurable interest.
Right.
That's called insurance.
That's right.
If I sell insurance in my state to somebody who doesn't have an insurable interest,
That's called gambling.
that's called gambling, but it would be insurance. I mean, it would be the insurance regulator that would say, no, I can't do that.
Well, no, actually,
I mean, the life insurance companies in my state are, in fact, told what life insurance they can sell and who they can sell it to.
Right. And actually, the concept of insurable interest is a fundamental concept in insurance. You have to have, in property casualty insurance, in order to collect on a claim, you have to have insurable interest at the time of the loss. And in life insurance, in order to buy a policy, there has to be an insurable interest. And it's it's a little complicated how it can arise, but there has to be one at the time you buy the policy. So that concept of insurable interest is fundamental to what we think of as insurance. And then the other part, of course, is risk transfer. In the issue of credit default swaps, there has been some discussion, and I know they're frequently called insurance.
Well, they serve the role of insurance. They may not technically be insurance. As to who would regulate them, one argument would be, well, it's insurance and we'll have the state regulators insure. The concern I would have is which state, and would there be a race to the bottom? What protects me as a Californian in a race to a bottom is even if an insurance company is created in the Cayman Islands or in some state that races to the bottom, my insurance regulator can protect me, and I'm not going to move to another state. I'm not moving to the Cayman Islands to get an insurance policy. In contrast, these markets can be moved anywhere. Transactions can be anywhere. And so I know that you believe in state regulation of insurance for consumers, for those who are in a fixed place. I'm not sure that we could have the states regulate the insurance of financial interests and or the gambling on financial interests.
Yes, I said there's been a lot of discussion about this in insurance regulatory circles. I would say there hasn't been a resolution of where the regulators are. And I share your concern that there are some differences between credit default swaps and other kinds of insurance that we are used to dealing with. And one of the major differences is that credit default swaps are so pervasive now with the banks, with the hedge funds, throughout the system. I think personally that this would be a challenge for the insurance regulators to say we're going to regulate that massive marketplace in addition to what we already do and, by the way, do a very good job of.
And we will be back in approximately 30 minutes. The committee stands in recess.